All right. Hello, everybody. Thank you for joining us today. I'm Sean DeVries, the Executive Director of BMAC. My pleasure to welcome you to this final webinar in our Sustainable Battery Value Chain series. If you missed the previous sessions, I encourage you to check out our website where you'll find the recordings and slides. And I want to start by emphasizing that we recognize the application of these requirements is going to be covering a wide range of organizations and applications. But really what's common here is these requirements impact the entire battery value chain. So our aim is to give you a little bit of a high level understanding of what some of these requirements are, some of the key individuals that or organizations that are operating in this space that can help you understand these more specifically to your operations and application. Pardon me. Also note that BMAC is gathering information on supporting technologies and services that are available to help you meet these requirements. And we're compiling a battery industry directory to highlight these and other solutions for the battery value chain. So if you haven't already, I encourage you to contact us, or you can use the QR code on the screen there to complete a very short online form to get your company and solution added to that directory. For today, I'm excited to kick off our session covering sustainability disclosures and access to capital. So before we get started, I want to acknowledge that I'm joining today from Barrie, Ontario, which is the traditional territory of the Anishinaabe people, which include the Ottawa, Ojibwe, and Potawatomi nations, collectively known as the Three Fires Confederacy. Pardon me, and also the Wendat Nation, Huron. Of course, I'd like to extend my thanks as this technical symposium is made possible by the financial contribution from the mining sector team at National Research Council Industrial Research Assistance Program. If you'd like to connect with NRCI RAP, please contact Peter Howell, and you can see his email address on your screen. So for our presentations, I'm very pleased to be joined by this excellent panel of speakers. We're going to be starting off today with Connor Chell, who's the partner and national leader of ESG legal risk and disclosure with KPMG. He's going to provide some insight on just what these sustainability disclosures are and talk a little bit about the risk of greenwashing under Bill C-59. Then we're going to move on to Art Robinson, who is the managing director of Longbow Capital Inc. And he'll provide the investor's perspective and share what investors are looking for in terms of sustainable investments. And then finally, Damian Newman, who's the CEO and co-founder of Greenworks ESG. He's going to explain what this all means from an operational perspective and some of the things that companies will need to do to demonstrate compliance with these requirements. So with that, pardon me, I'm going to turn it over to Connor for our first presentation. And while he's getting his slides ready there, I'll just remind folks that we will be taking questions at the end as time permits. So you can use the Q&A box at the bottom of your screen and submit your questions throughout, and we'll get to as many as we can at the end. So Connor, over to you.
Thanks very much, Sean. Can you see my screen?
Yes, we got it.
Okay, fantastic. So yeah, thanks very much, Sean. Thanks, BMAC, for having me. Thanks to my fellow presenters, Art and Damien, for joining us. And obviously, all those in the audience today. Obviously, what we're talking about here today is quite topical and a lot of interest in the Canadian market with these topics. So very happy to be here. Just in terms of what I will be talking about, I'm a lawyer by trade, environmental, regulatory, and sustainability. So I'm going to be talking about some of the sustainability considerations specific to legal requirements that we're seeing that are emerging and proliferating at a pretty significant pace. So I'm going to move through the slides relatively quickly. We will circulate them subsequent, and there will be time for Q&A, obviously, at the end. So looking forward to the discussion. Just in terms of what we'll be talking about over the next 20 minutes here, as I say, we'll touch on some of the new and emerging sustainability regulations, many of which you've probably heard of. We're going to spend a fair bit of time talking about greenwashing and Bill C-59. I think that has a fairly substantial potential impact on the audience here today. We'll also talk a little bit about how organizations can go about preparing for change. And then I think we'll leave Q&A until my fellow presenters have presented as well towards the end. So jumping right into it, new and emerging sustainability requirements. Off the top, one of the big ones that many people have probably heard of are the Canadian Sustainability Disclosure Standards. So at the end of the last year, the Canadian Sustainability Standards Board released their final version of these inaugural sustainability disclosure standards, CSDS1 and CSDS2. CSDS1 is general sustainability requirements, and CSDS2 are more specific to climate-related opportunities. And going back a little bit in terms of background, these standards are based on, well, at a very high level, and initially the task force on climate-related financial disclosure kind of set out the 4 pillars. And then that has been picked up internationally by the International Sustainability Standards Board. Many jurisdictions around the world are adopting the ISSB standards, either in whole or in part. Canada would fall into the in part category. I'm not going to walk through each and every requirement. There are some transition reliefs available there as well. But needless to say, the idea here is for publicly traded companies, these reporting standards will come into effect likely at some point. As of this year, they're voluntary, but what will likely happen here over the next number of months and years is that they will become mandatory, and how that will go or come about, practically speaking, is the Canadian Securities Administrators are likely to adopt them over the next year or so, and at that point they will become legally mandatory. So in addition to financial reporting requirements that have existed for many, many years for publicly traded companies, these standards will also become mandatory. Then I'd also just mention the Canadian Business Corporations Act. So the government of Canada over the last number of months actually announced an intention to move towards mandatory climate-related financial disclosure for medium to large size private organizations via amendments to the CBCA. We have yet to see those amendments pass, and obviously what's happening at the political federal levels, both in the US and here in Canada, may have some impact on that timing. But what we've seen from other jurisdictions around the world is that there likely will be some form of mandatory climate-related financial disclosure for, as I say, medium to large size enterprise on the private side as well. One of the other emerging pieces of legislation that has the ability or potential to impact BMAC members is the Modern Slavery Act, so Bill S-211. That came into force last year, May 31st of each year. Organizations of a certain size, if you meet 2 of the following 3 thresholds, so 20 million in assets, 40 million in revenue, and or 250 more employees in any financial year, they need to report out on basically the potential risk associated with forced or child labor within their supply chain. So for BMAC members, obviously, I think that's something that's top of mind for many. I'm not going to walk through this slide in great detail other than to say the first reports were due May 31st of last year. We saw about 6,000 reports filed with Public Safety Canada, who is the regulator that's responsible for the time being. And in terms of just very quickly key insights and things that we saw from that first round of reporting, about 90% of those that reported made public commitments to basically address forced or child labor in their supply chain, but only about 5% have done any sort of mapping beyond tier 1 suppliers. So those would be your direct suppliers, and we expect those numbers to increase as reporting evolves and as we move forward. The other thing that I would mention here as well is that the federal government announced an intention to implement incremental supply chain due diligence legislation. So this Modern Slavery Act, the way that it works is it's a transparency-based piece of legislation. And what I mean by that is the only actual requirement is that those companies that need to report actually have to report out on what they may or may not have done to eradicate forced or child labor in their supply chains. So that's the transparency piece. You just have to tell the government what you have done or haven't done. And that's the only actual requirement. What we expect to happen and what we've seen in other jurisdictions is that we're going to move into a more prescriptive form of regulation. So once the government gets its arms around what the potential risks are and what organizations might be impacted, this incremental piece of legislation is likely to be more prescriptive in that it'll say you shall do the following things to basically address those risks. So obviously that'll have an impact on a large number of Canadian organizations. Other ESG legislative developments of note, I won't go through these in any level of detail, but I highlight these just basically to outline that there's been a large number of mandatory ESG related legal requirements that have come on over the last 18 months or so. So here's a few examples. This PFAS reporting requirement That has to do with forever chemicals. And the idea there is, again, the government is looking for transparency for any organization that manufactures, imports, or uses a list of about 312 forever chemicals. You would have seen similar type of regulation historically with things like chlorofluorocarbons in refrigerants, as well as PFOAs, like nonstick coatings and that sort of thing. So the government is really trying to crack down on the use of those chemicals. They bioaccumulate in humans, and they don't biodegrade. So these are kind of the worst of the worst. Similarly, the plastics registry. So any organization that brings plastics onto the market, they're going to have to basically report out to the government as well. And I guess the one thing I would say for both of these requirements, there are significant penalties for failure to report or reporting inaccurately. So that's another trend that we see on the sustainability front. The government's asking for transparency, but is also being quite punitive for those that fail to comply. Another couple pieces of legislation that more so impact the financing side of the sustainability equation. The first one is the Climate Aligned Finance Act. So this is a bill. It's not in force yet. And again, it remains to be seen when or whether that will happen, given what's going on at the federal level. But what the bill seeks to do at a high level is for federally regulated financial institutions. So think big banks, insurance companies, trust companies, that sort of thing. They actually would be required to create action plans and to reduce absolute emissions. And that's important because you're probably aware many emissions targets aren't based on absolute emissions. So that's going to be a big change if this comes into effect. And another piece there is the government is saying that organizations that are impacted, so those FRFIs, won't be allowed to rely on carbon offsets, carbon capture, or future invention or unproven technology until and unless they've actually abated their absolute emissions to the extent possible. So that will be a big change. There's also a requirement for board members with climate expertise, and also an enhanced duty to prioritize climate for those institutions. So that won't have a direct impact on BMAC members, obviously, but on the financing side, if this becomes legislation, you can expect that those institutions will be passing or flowing through a lot of those requirements to the investment and lending portfolios that they have. Similarly, the Canadian Sustainable Finance Taxonomy, that has more to do with sustainable investment guidelines. I won't get into that, but it has to do a lot with the way that funds are named and labeled and that sort of thing. So it'll act as a bit of a tool for investors when they're evaluating where they're putting their money from a sustainable finance perspective. So I'm going to spend a little bit more time here on the greenwashing and Bill C-59 side of things. So for those that aren't aware, greenwashing at a very high level has to do with public commitments relative to a product, service, or organization where environmental benefits are exaggerated or overplayed, or on the flip side, where negative environmental impacts are potentially downplayed. So that's greenwashing at a high level. Governments around the world, moving on to this slide, have started to regulate that sort of commercial misrepresentation. So on this slide here, KPMG, we did a global comparative report of new and emerging greenwashing regulation. I often get asked the question, is Bill C-59 and its amendments to the Competition Act, are those new? Are they unique from a global perspective? And the point of this slide is to say that no, they are not. There's somewhere between 25 and 30 different jurisdictions around the world that have something that's comparable. We also did a CEO Outlook survey of Canadian CEOs, and that's up in the top right there. And what we found was approximately half of Canadian CEOs felt that their sustainability or environmental claims could withstand scrutiny, and that's actually significantly lower than the global average. So clearly some level of risk there for Canadian organizations. And 75% of those Canadian CEOs said that they haven't changed their strategy necessarily when it comes to climate, but they've certainly changed the way that they plan to communicate about it. And that's a result of Bill C-59, which is heavily punitive, which I will talk about now. So the first thing to remember here is, I'm talking about Bill C-59, but in fact, it's already passed. It received royal assent in June of last year. So everything I'll talk about here now is the state of the law as it exists today. So Bill C-59, it was an omnibus bill, but it did include anti-greenwashing provisions. And that's what we're going to focus on here. And it's really important because, as I mentioned a minute ago, it's highly punitive, this new regime. So in the bottom left there, you'll see the potential penalties. So it's the greater of up to $10 million per misrepresentation, 3 times the value of the benefit derived from the misrepresentation. And if that can't be determined, then 3% of worldwide gross annual revenue. So all three of those categories are massive, obviously. And the thing to remember there is it's on a representation by representation basis. So say, for an example, an organization has an ESG report that's 50 pages or so. It's each representation within that document could be subject to these penalties. And what we've seen so far, working with clients across Canada and across a number of industries, is that on average, you'll see up to 1 potential misrepresentation per page of sustainability disclosure. So again, if you have a 50-page ESG report, chances are you're going to have somewhere in the neighborhood of 50 potential misrepresentations. And that's not to say that companies are doing this intentionally necessarily. It's just that we've moved so rapidly from a completely voluntary, unregulated sustainability disclosure environment into one that's highly punitive and highly regulated as a result of C59. And just anecdotally, I often say this to clients just to give a little perspective and context. If you've heard about the Sarbanes-Oxley Act a couple decades ago in terms of financial reporting and transparency and that sort of thing, had a huge impact on the market and reporting of financial metrics. I think Bill C59 here in Canada is going to have a bigger impact than that. And the reason I say that is because it applies not only to publicly traded companies, it applies to any organization that makes a representation in the public domain. And it also applies to any environmental or sustainability metric, right, which is much broader than what you would see typically on the financial side. So huge scope. And then just talking about the provisions themselves, the 2 key ones that were introduced through C59, product or service benefit claims. So those are where you're talking about a product or a service specifically. So things like low carbon fuels, sustainable aviation fuel, that sort of thing, those would be caught here. And the idea is you can still make those representations, but they must be backed up based on an adequate and proper test. So that those terms are defined in the case law. Not going to get into all of the details. Basically, you need to prove your claims of that variety. And then similarly, business or business activity benefit claims. So these are claims of the environmental variety that don't have to do with a product or service specifically, but they do have to do with, again, a business or a business interest. So think things like net zero claims, carbon neutral claims. Those are kind of the big buckets that would be caught there. And this provision has created quite a bit of uncertainty in the market. Those sorts of claims now must be based on an internationally recognized methodology. There's still a bit of uncertainty. The Bureau, Competition Bureau's released some guidance on that topic, but a lot of uncertainty remains, and we do expect that there'll be a significant amount of enforcement, which I'll talk about here in a second. There's a number of complicating factors that were involved in Bill C59. The first is many of the definitions in the bill and then in the Competition Act are left undefined. So that creates a bit of an issue and some ambiguity, certainly. And then the next two in combination are probably the most problematic from a legal risk perspective. The first is a reverse onus. Simple way to think about that for these 2 provisions I talked about. You may have heard the term, innocent until proven guilty. The reverse onus is the opposite of that. So what's going to happen is complaints can be made to the Bureau. Once that complaint is certified by the Bureau or by the tribunal, at that point, it's up to the company who the complaint is being made against to prove or verify that what they've said is not a misrepresentation. So obviously that's pretty problematic, and it can cost a lot of time and resources, I think, for organizations to do that, regardless of whether, at the end of it, they're innocent or guilty of a misrepresentation. The other piece that's associated with that reverse onus is this private right of action. So what this means is any individual, i.e. any consumer, can file a complaint with the competition tribunal against any organization. And if the tribunal determines that that complaint is in the public interest, i.e. has the ability to impact a consumer or consumer behavior, which is a very, very low threshold, then those complaints will be allowed to proceed through the tribunal process, and as I say at that point, flips over to reverse onus. So in many ways, what companies are worried about is more of a reputational impact and the costs associated with going through that process. Again, that can take many months and years to do, and at the end, you may be guilty or innocent, I suppose, but you're going to spend a lot of time and money defending yourself if you are the subject of one of those complaints. Just very quickly, I know we're a bit short on time here. In terms of who this act applies to, any Canadian company making a representation in Canada, or any foreign company making a representation about operations or business interests in Canada. So very broad again. The legislation itself is not retroactive, so it doesn't apply to claims that an organization may have made prior to the passing of the bill. But that being said, many organizations leave their historic ESG disclosure in the public domain, like a 2022 ESG report as an example. If you leave that in the public domain, there is the potential that that's seen as an ongoing representation and brought within the ambit of the act. And the takeaway for all of this is substantiation is required for all claims. So again, there is no prohibition against making claims about environmental performance, product, service, benefit, or business interest. But if you're going to make any sort of claim of that variety, it needs to be substantiated. So that's the real takeaway. If you don't remember anything else from the discussion here today, that's the one thing that I would encourage you to remember. Already talked through most of the legal risks here, so I'll just leave those for now. Again, the deck will be circulated at a later date. We also have a few points here relative to the Competition Bureau's guidance that was released a few weeks ago, actually, earlier this year. So you can take a look at that if you like. And maybe what I'll do before I pass it over to my fellow co-presenters is just leave you with a few considerations for the battery metals industry specifically. The first has to do with sustainability strategy. Again, substantiation of sustainability-related claims like net zero, carbon neutrality, emission reduction generally, those need to be proven now, as well as forward-looking statements. I know this is probably pretty common in the industry, talking about contribution to the energy transition, that sort of thing. And then obviously you want to try and avoid the use of kind of triggering or keywords such as, green, environmentally responsible, ethically sourced is a big one that comes up in terms of supply chains and emissions and that sort of thing, or low emission. And the other thing to keep in mind here is with the proliferation of this sort of legislation, obviously there's a lot of public and media sentiment that's attached to that. And I think that's going to result in an increasing number of complaints, specifically on the greenwashing side, and really focusing in on that responsible supply chain and due diligence. Those elements will be very important for the industry going forward. So maybe I'll just leave it there. And obviously looking forward to my co-presenters, hearing what they have to say. It's always enlightening. And then looking forward to questions towards the end.
Thanks very much, Connor. That was excellent. And so many requirements there. I'm sure there are going to be a lot of questions. I know I've got a big list here of my own. So before we get into that, though, we have Art here next, and I'll turn it over to you, Art. And if you want to share your screen.
Great. Perfect.
There we go. We got it.
So I know we're running a bit short on time, so I'll make this relatively brief, and obviously happy to answer any questions at the end. My name's Art Robinson. I'm with Longbow Capital. We're a Calgary-based private equity firm. These are sort of the quick Coles notes on our firm. We actually manage about $1.8 billion of capital. We've been around for 27 years. We started originally in the oil and gas sector, and moving through from 2017 onwards, moved into energy transition. Originally started as energy technology, and energy transition is where we are today. What that looks like from a fund construction point of view, and the one that's pertinent to this call, is Lithium Battery, which is a Calgary-based battery manufacturer. Originally started in the oil field and today operates globally and manufactures cells and packs, modules for lots of different businesses. In particular, some of the unique aspects of their business are building batteries for Caterpillar and their hybrid locomotive division. Also build marine batteries for Viking cruise ships and various things like that. So ESG and reporting is something that is talked about a lot, has been talked about a lot over the last year, and is going through a bit of a rapid transition right now with the election of Donald Trump in the United States and various other groups pulling out of both climate action and diversity initiatives, as we're seeing in a lot of larger organizations. For us, however, though, it is still a key part of our investment mandate, a key part of our strategy, and it's something that any potential portfolio company, at least in our company, would need to follow. For us, it really is around environmental stewardship, social responsibility, and governance. Those are three areas that we focus a lot of time and attention on. In terms of environmental stewardship, it really is around reducing greenhouse gas emissions, conserving resources, and obviously contributing to the energy transition. For social responsibility, it's around human rights. I believe we heard that earlier, diversity, safe workspaces, and governance is transparency and accountability, and ethical practices within the companies. How that works for us is it starts right at the very beginning of the investment process. One of the things that we do is work through a detailed and dedicated questionnaire around ESG with all of our portfolio companies. And it starts even before the investment process happens. The first thing that questionnaire answers is, does this fit our investment thesis? So if you were a battery manufacturer or minerals or whatever the case may be, and we're looking to us for capital, we would need to answer one of three questions, which is, does your business have a direct decarbonization angle? And that could mean a whole bunch of different things. It could mean that you're supplying services to the power grid, or, in the case of batteries, obviously, if you're manufacturing cells or packs or whatever the case may be. The other thing we're looking for is supply chains. Is your supply chain providing an opportunity for a greener future? And are you part of an evolving energy system, which of course everybody on this call certainly would fit into that category. Once we've determined that the investment fits within our mandate, we'll begin a pre-investment review. And that is really where the due diligence questionnaire starts. And that is around the collection of data and an ESG risk assessment. Obviously, we look at businesses for their capability to make money, building into markets, and obviously generating a return. But as part of that whole process, there is an ESG element. Once we've determined that it is a mandate fit and we've checked all the boxes from an ESG point of view, we'll move into an investment memo and then make the investment. But it doesn't end there. The requirement to manage and monitor ESG performance remains throughout the life of the investment. We provide a number of reporting templates that we ask our portfolio companies to fill out. It usually happens at the board level. We would do it once a quarter, or ask the portfolio companies to do it once a quarter. And then there'd be an annual review as well. We remain active from a governance and engagement point of view on all of the ESG topics that are important to us, but they're not also just important to us, they're important to our investors as well. So really where this comes from is us being asked as a private equity firm to contribute to the ESG reporting requirements of our LPs, our limited partners, which include some of the largest banks in the country, government entity being Business Development Bank of Canada, and various strategics like Caterpillar and Berkshire Hathaway. We do have reporting requirements. We do this for all of our portfolio companies. We benchmark the portfolio companies against each other and against the market as well. And of course, try to continuously improve. So if there are certain areas within our ESG infrastructure that are lacking for one company but are good for another, we'll utilize the portfolio company's best practices to move that through our portfolio. The other thing, and the other reason why this is important, at least it was, over the last 10 years, is buyers also are interested in ESG. So it just doesn't end with our investment. We will provide all that information to a prospective buyer, or the company will, and often that will reduce the due diligence process and the time to sale by up to 1 to 2 months, because it's something that the company has been able to demonstrate a track record around and understands how to mitigate risk, throughout from an ESG perspective. So in terms of the timing of all of this, we do it on a fairly regular basis. And, really what we're trying to accomplish is a framework that not only works for the portfolio companies, but also works for us in terms of reporting. So we try to make it as, and I think all firms are the same, try to make it as unencumbering as possible. But it still is something that the business needs to work at, and it is something that takes time and does require a continuous effort. Some of the things that we look for in the questionnaire, which is part of our due diligence process, is, what are the company's current ESG practices and policies? Do they have reporting metrics, and what are those details? We tend to look for those for the last 5 years. Not all companies, certainly private companies, have that. I would say most don't, so it is something that we look to build. But I would add that if you are doing this in your businesses today, it is something that buyers will pay for. We will pay a premium for companies that have ESG policies and reporting metrics and details of how they're going about and managing their ESG. The other things our questionnaires, or at least our due diligence process, gets into are data security. Cybersecurity is something that matters a lot, and it is encompassed in ESG. Your supply chain, and how, well, we talked about the Modern Slavery Act earlier, I think, and certainly that's something that we focus on as well. Climate obviously is a big one, and we're looking into a company's efforts to reduce GHG emissions, how they participate in carbon offset programs, and any other risks related to water usage or other ecological sites. Governance, as I mentioned earlier, is a big one. That's also part of our process. And a lot of private companies tend not to have boards. Some do. If they do have boards, we spend a lot of time looking at that and how the board works together, and how the board works with the company to mitigate various risks within the business. And of course, the last thing is just the team and working environment. Is it a safe workplace? Does the company have wellness programs? What do they do to support employee volunteering? Are there any charitable donations? Whistleblowing, as we just talked about earlier, or was talked about earlier, maternity policies, codes of conduct. Those are all things that we'll look for in terms of are part of our investment process. Not the most exciting topic, but one of these things that we got to do to create value. And as I mentioned, we report both on ESG and DEI. Both are equally important. Interestingly enough, DEI is being dropped from a lot of corporate agendas, or has been dropped from a lot of corporate agendas recently. We think it's something that's here to stay. I mean, it just makes good sense, and it's ethical, and we want to be giving everybody an opportunity to feel safe in the workplace. And from a ESG point of view, it really is a bit of a reporting burden, but the things that we'd look for, is lined out here. In terms of reporting metrics, this is a bit of a busy slide, so we'll share it with everybody after. But really, the 6 areas that we're looking to report on, and the metrics that we have, are around climate change or climate action, diversity and inclusion, governance and business ethics, cybersecurity and data privacy, human capital management, and innovation. And around innovation, that would include patents and trade secrets and whatever processes the companies are doing to continue to move their business forward. Current landscape, it is changing quite dramatically, but I don't think it's going to have any impact on how at least the private equity sector looks at ESG and DEI. It is something that we have to focus on and have spent a lot of time building out our best practices. We know that a lot of orders are coming out federally, particularly in the US, about eliminating DEI and ESG programs. I don't think we'll see the same thing in Canada, though we have seen a number of Canadian banks pull out of the Net Zero Alliance, and we continue to see or believe more of that is going to happen. That said, a lot of these large institutions are also saying that even if they are withdrawing from the Net Zero Banking Alliance, they're going to continue their dedication to the programs that they've set up. And we expect that to continue. So in terms of what you should think about if you're looking for private equity investment is, I mean, and I'd be happy if you wanted to reach out to me and we'd give you, sort of the questions that we ask, but I'd be proactive about it. I'd focus some time and attention on making sure that those 6 categories I talked about, you have answers for of how you look at them. And sometimes, the best answer is we just don't focus on it. And that's better than saying, you do, but actually don't. So I would encourage everybody to be proactive in terms of building out your ESG and DEI policies to however they make the most sense for your company, because groups like ours, if we're committing capital, they are important to us. And the one thing I didn't mention, which is probably worthwhile mentioning, is we are a mid-sized private equity firm. Our check size ranges from $10 to $50 million. And I would suggest that most of us look the same. We're, in that size bracket, we're going to be looking for the same things because we have investors that are asking it from us. And so it is a bit of a flow through effect where whatever we're asked to report on, we need our portfolio companies to report on as well. And with that, I'll turn it back over.
All right, thanks very much, Art. That was fantastic. And with Connor touching on so many requirements, certainly not any less from the investment level, it seems. So there's a lot happening here. But now, how do we navigate through that? And that's going to be our next step. And welcome Damien to give us some thoughts on what this means from an operational perspective for organizations.
Thanks, Sean, and thanks to Art and Connor for their excellent presentations and for everyone showing up today. Really appreciate it. I will go a little quicker just so we can get some roundtable conversations going. But to introduce myself, I founded Greenworks ESG a little over 5 years ago, almost 6 years ago. I actually am not from a career in sustainability. I was sales and marketing in oil and gas on the environmental side of the industry, and just saw this massive wave of ESG. And every financial article I was seeing 6 years ago was all about how it had gone from $1 billion industry to a $40 trillion industry in the span of a couple of years. And I just saw that this was going to get pushed down on everyone. So we took a very different approach for how we looked at building out an ESG platform than somebody that might have worked in sustainability their whole career. I'll also use that time frame because I'm sure Art gets asked. I know Connor and I get asked a lot about Trump being reelected, and will that kill ESG? Will it kill DEI? With all his efforts in the first couple of weeks, it would seem like that. But I would also harken back to 6 years ago when I started this. Was Trump's first term, and in his second year in his first term is when ESG blew up. And so when we see these pendulums swing back and forth, I think this is all that's happening right now. There's a nice corrected measurable approach, it will be a measurable approach when it's all said and done. So with that, before I chat about operational usage and Greenworks itself, I just thought I'd quickly touch on a couple things in terms of the flow of capital. And Art had such a great presentation there because of the fact that institutional investors in Canada completely came out and endorsed the CSSBs issuing the CSSD 1 and 2 back in December. It was universally endorsed by institutional investors across Canada. And a lot of that endorsement came from their comments while it was in the comment period, and the fact that the CSSB listened to those comments and created a measured approach to kicking this off, which Connor's touched on a lot. So I won't reiterate the fact that there is transition relief in certain areas, and it's not as daunting as a lot of people thought. very dissimilar to the CSRD in the EU, which was a very daunting release a year ago. And with that, there's a lot of measures in place right now to roll some of that back and make it easier for smaller companies. And even within that, you see investment groups just this past Monday released a press release with over 200 financial service institutions with over $1 trillion or $6 trillion, bringing up the fact that they don't want this rolled back. They don't want the integrity lost on their voluntary disclosures, which 7 of the 27 EU countries have actually already put into securities law. So back to Connor's point again about what will happen in Canada, it's pretty easy to predict what will happen in Canada because we're usually 1 to 2 years behind the EU and all of this. So really easy to understand what's next. The problem with what's next is that most people look at it as this incredibly daunting who, what, where, when, how do I manage this? How do I do this on budget? How do I do this off the side of my desk? I think the biggest thing with this slide is the fact that people are always surprised to hear that when we're dealing with customers that are 3, 4, or 5 billion-dollar market cap companies, for the most part, they are doing it off the side of their desk. They're doing it as a committee or as a team, and they're getting data from different levels throughout the organization. And that is one of the biggest pain points is the integrity within that data. When you're dealing with all of these different dynamics, it becomes very daunting, not just the exercise of collecting the data, but then when you go to report publicly or to an individual stakeholder, how do you know there's any accuracy to it? I have a billion anecdotal stories of meeting with clients and talking about how stressful this is for them. But my favorite to date is just one lady saying that if you put a gun to her head, she could not tell you if there's any accuracy or where any of the data actually came from that's in their report. But that's pretty common amongst most folks that we meet with on a regular basis. So what we built and we really looked at when we built this is how do we, first and foremost, when we're looking at data, where we're talking about report building, we're looking at assessments and helping you manage gaps in your reporting. The first piece is we've got to mirror your workflow. It has to be as seamless as possible to what you're already doing, but understanding what you're already doing with sharing spreadsheets around the organization is just fraught with human error and inefficiencies. So we needed to mirror it, but we needed to streamline it where it becomes that living document. And most importantly, and going back to C59 and a lot of the risk with this, is we needed a fully auditable workflow throughout the entire process and a single source of truth so that you can substantiate your communication on the processes and methodologies that got you here. That is the biggest piece of this. Can you back everything up that you're stating when you go to report? And the key with reporting is it's not just that year-end report that everyone thinks about, this big, glossy, beautiful communication piece that the companies will put out. It's those individual stakeholder requests. About 80% of what our clients use our system for is actually internal reports and individual stakeholder requests for specific metrics, and be able to provide that accurately and with organizational continuity on the communication within those reports is really key. And a perfect example of that is those requests for pricing or bid requests, where you have the sales team, the estimating team, trying to get a bid across the finish line, but they're asking their ESG department, their safety department, their IT department for all this different data, but all these different policies, and making sure that that is accurate. That is more where we're seeing when you talk about sustainability data and sustainability policies, is they're going not so much focused on that year-end report, but again, those individual stakeholder requests. And then the last pillar of our tool is the assessment piece. The reality is with AI, what we've done is we've encompassed it inside the software so that you have the complete security and privacy of not being on the open web, not putting it into a chat GPT where everyone can see what you're asking it about your company, but where it can then feed back information within seconds on what is your legal risk, what is your compliance to new frameworks like CSSD, rating agencies and what they're looking for, and assess gaps in that. Your modern slavery policy, your safety policies, whether you're a large company, small company, to be able to assess gaps in those policies. And we even have a new cybersecurity assessment that will launch in February that will assess your cybersecurity policy and understand the gaps in that within seconds. So to be able to work on those 3 pillars to basically remove all of the challenges of the who, what, where, when, and how do we manage all of this. And then I just wanted to pull a slide from our institution, our industry association deck. We work with multiple industry associations, and we work with them because we're really the only solution globally that looks at the small, medium business. We're going to let our competitors fight for the big multinational with, their 6-figure yearly price tags on their software platform. We're fine to let our competitors have that business. We want to look at those small, medium businesses that the biggest thing is it's so daunting to get going and understand what you have to do. But the next piece, and a lot of the pushback on a lot of this is it's too daunting, but it's also too expensive to be able to manage this. We have platforms and tiers within our system as low as $5,000 a year. So this is not a break your bank type product for especially small, medium businesses. And really what we were trying to create with when we built Greenworks is a tool that would mitigate your risk with your sustainability data policies and create that organizational continuity in your messaging. And I think that's really key to avoid any of the pitfalls, but be able to, again, manage this where you have that peace of mind when you're sharing the data to a variety of different stakeholders, that when you share it, it's not going to come back on you and create a bunch of risks. So again, I want to do just a very quick presentation, and I thought we could jump into a Q&A.
Great, thanks for that, Damien. So I'll welcome Art and Connor back as well. And to our audience, please, if you have questions, you can submit them through the Q&A function there. Damien, I'll just stay with you for a minute if we could. And, we've talked about these wide variety of requirements, whether ESG, DEI as well. Can you just kind of explain a little bit, what does it mean to actually, what information are people collecting? What are they actually reporting out when they're going to be doing these types of things?
Well, I think the interesting piece, Sean, and when you look at the controversy or the politicization of ESG and DEI and those acronyms, if you remove the acronyms, every business has been managing 90% of this already. There's very few elements that fall under that umbrella of ESG that a business hasn't already been maintaining. So the real transition here is obviously on a couple key pieces to it. In the E, with being emissions, small businesses, how do you manage what your GHG emissions are? How do you calculate it? How do you manage it? But the rest of it, they've been managing, but they've just been managing it very inefficiently, right? With the spreadsheets and the emails and the lost data and where the heck is this policy piece? And I think that is the interesting dynamic to this, is that if you just remove those acronyms, again, 90% of it, it's just operational efficiencies when we're really looking at it that way.
Great. And Art, this is the kind of information you're looking for as well. How often is it there? How often is it streamlined and in the kind of way that you're looking for it, or is it a bit of work to dig that out?
Great question. Am I allowed to say never? That's probably closer to the truth. The reality is doing this stuff takes time and it costs money. And as a private business, it usually falls down to the bottom of the priority list. And so I would say in most of our portfolio company investments, we're working with the right from the start to build out these programs. I would say it's not something that smaller private businesses spend a lot of time on unless they're required to by their customers. So, service-based businesses rarely have these built out, which is why, what Damien provides is critical for a lot of business owners. I think just having access to that expertise and capability in a way that is not cumbersome, makes a lot of sense. And after hearing that presentation, I'm going to encourage a lot of portfolio companies to give them a shout. But yeah, it's not something that we see regularly. it is something that we spend a lot of time working with our portfolio companies to develop.
Okay. And, it's an interesting comment that you made earlier that really ESG isn't just about securing the investment. There's also the opportunity for a premium as well. And so I think that goes to show that there's a reason or some justification for companies to do this and make those investments then.
Yeah, absolutely. I mean, and if you think about it just purely on economic terms, it will take us a year and probably, between effort, time, lost opportunity to look at other things. Depending on the size of the investment, it could cost up to $1 million to $5 million to, sort out these programs. And 5 million obviously would be for a much larger company, and obviously a lot less for smaller companies, but it's expensive. And it's a major consumer of our time to help build out these programs, and we'd rather just pay for it up front.
Wow. Connor, the requirements that you outlined many of them, of course. We talked about some specific things here towards the end as well. How unique are these different requirements? Because it's a little bit daunting now from an organizational perspective to say I have to meet several of these. When companies are doing that, is it lining them up for success on a number of these fronts?
Yeah, I think at a high level, the answer there is yes. I mean, most of the requirements and the ones that are becoming mandatory certainly are coming from either an internationally recognized standard setting agency like the ISSB as an example, or it's coming from like very well established developed countries or jurisdictions, right? Like modern slavery, our legislation is very similar to that already imposed in the UK and Australia. The US has something similar, but it's more specific to a particular region, the Uyghur region, China, or the Uyghur population in China. So those pieces of legislation, they're not unexpected. Same thing with Bill C-59. I mean, most of the developed world has those sorts of regulations already. And I mean, the approach that we typically advocate for clients, especially in light of all of the politicization that we've talked about and a little bit of the rhetoric, especially over the last number of weeks, is to try and cut through that and really focus on, what are the legal and what are the mandatory requirements. Focus on those. And to answer your question a bit more directly there, Sean, if you focus on, say, for instance, climate-related financial disclosure, whether you're public or private, on the public side, you're going to have those requirements anyway. On the private side, yes, the CBCA may be changed, but certainly you're going to get those requests from lenders, whether those are, large FRFIs, whether that's a private or the private equity community, they're already asking for those things. So those are things to focus on. And then for, BMAC members specifically, I touched on it very briefly, but, I would advocate focusing on the supply chain aspect and the reporting requirements there. Modern slavery, as I say, is the first one, but, we're also likely to see things like emission requirements and reporting relative to organization supply chains more generally, right? So wherever you exist within that supply chain, if you haven't received like these sort of questionnaires and requests either from suppliers, customers, financiers, you're going to, right? So it's just a matter of being aware of that, and for some organizations, Art touched on the cost. Like there is a cost to some of that. And what we also say is, you don't have to do everything all at once, though, right? Like not each of these things have the same potential impact, nor are they on the exact same timeline. So look at the ones that, as you'd alluded to there, Sean, can kind of check off a number of boxes domestically and internationally potentially, and then the ones that are actually have the legal reporting requirements, focus on those. And then you're probably well positioned to also address, any subsequent or emerging regulation that comes up.
Great. And staying on that cost factor for a second, Connor, because you talked about the greenwashing, penalties associated with that. The penalties are rather significant. And as you mentioned, per misrepresentation. So this can build up quick. My question is there any safe communications these days?
Similar to Art's response in terms of, do you get the sufficient data? No, or never. No, I should be facetious like that. As I was touching on in the presentation, nothing is actually prohibited in terms of representation, but you do need to substantiate it. And what we find is many organizations have done a lot of the work to provide that sort of evidence or substantiation. Now it's just a matter of being able to communicate that. I mean, obviously, there's also some organizations that have made representations, particularly around, net zero emission reduction, contribution to the energy transition, that sort of thing. And there isn't a lot to back it up. I'd say that's the minority, though. But those cases certainly exist. And if you're in that camp, yeah, my recommendation would be to either substantiate those claims, go do the work to actually prove those claims out. And if you don't have the time or the resources or whatever, you're probably pretty well served to remove those, at least in the short term, from the public domain.
Great. Damien, you had mentioned, I think it follows up well in this, you talked about the integrity of the data. Can you just kind of describe what you mean by that? What is this, data integrity?
Well, I think it goes back to the number one pain point when we're meeting with a new company and we ask them, how can we help you today? What is the thing that keeps you up at night and gives you nightmares? And it's all about the idea that, and again, no matter what size company we talk to, it's always the same. It's that person that's responsible for the data, collecting it from maybe 10, 20, 30 people. And those 10, 20, 30 people collecting it from another 10, 20, 30 people, and then another layer. And then at some point along the way, that spreadsheet got changed, manipulated, and who knows what happened. And that was really the key focus, is how do we remove that human error and inefficiency from all data collection. And I think that's really the key when speaking with, the big four firms like KPMG, and asking them how they do an assurance audit, and looking at it's the process and the methodology. Can you prove out and can you substantiate where that number came from? Because they can't be on site and go, oh, you used 100 cubes of water versus 102 cubes of water. But they can review in great detail that process and methodology. And that's going to be really key, like Connor mentioned, as this goes from voluntary to standardization to mandatory. And with mandatory will come the need for assurance that the data is accurate.
Yeah, and it seems like this is inevitable because, as we talked about, you're going to get it through the supply chain. You're going to have to, provide data to your suppliers, also to the investors. Art, you mentioned that the requirements fall on you as well. You have reporting, so how does that fit in the reporting that you need to then do? Are you finding those are similar requirements as well? This all falls in line. And I guess that makes your job of working with those that you invest in that much more important in ensuring there's integrity in that data as well.
Yeah, and I think it was in Damien's presentation, he had PSP investments on there, and they're actually our largest limited partner. They have fairly stringent reporting requirements, which we pass on to our investee companies. So yeah, it is something that we're focused on every single day, and the only way it works is if it's being done properly at the portfolio company level. So we'll aggregate all that data and put a report together on our own fund. We won't name companies specifically, but we will collectively aggregate that information and provide an annual report that details our ESG and DEI program.
Okay, great. In the investment space then, would you say that this is now getting commonplace, these kind of sustainable investments in these funds, or is your organization kind of one of the standouts?
Well, I think there's a lot of companies focused on it. I mean, Brookfield just raised a $15 billion energy transition fund. And then, of course, there's smaller groups that have $100 million. So it was a hot space for the last 6 to 7 years. This has been something that we've been doing. Well, I've been doing it my entire career. The companies I invest in today are exactly the same ones that I would have invested in 20 years ago. We just didn't call them ESG related or energy transition businesses. Give you an example. In 2016, I invested in a geothermal drilling company. Back then, that was in an energy services fund. Today, that's energy transition. The battery company I mentioned earlier, called Lithion today, back then it was called Engineered Power. They manufactured batteries for downhole drilling equipment in the oil and gas sector. And today they manufacture batteries for all sorts of different areas. But back then, that was just an energy services company, and today it's an energy transition business. So, I think there's a lot of different ways to get capital. There's a lot of groups focused on the space. It was easier to raise capital if you had an energy transition angle a number of years ago. I think that's changing. In fact, we've seen it change dramatically even in the last 2 weeks, where funds no longer are looking specifically for an energy transition angle. The only way groups like myself are going to raise capital has nothing to do with environmental stewardship, but has everything to do with results. So I think we're not unique in the fact that we invest in this space. I think there's going to be less players going forward because capital won't be as easy to get. But there's still going to be players who are groups that have been successful because they invested with the right management teams and in the right spaces, and they'll still continue to get capital. It just won't be what's the right word I'm looking for? Like a hot, it won't be a trend. It'll be just based on good economics and good value creation.
Yeah, I mean, it sounds like it's a requirement coming, but also just a good business decision and a wise way to take the business going forward. So I think that's all that we have for questions right now. What I want to do is just leave it if any of the speakers wants to kind of sign off with a closing thought. Leave it open up here. Damien, any thoughts that you wanted to share?
Well, I'll summarize one of my favorite anecdotal stories, but after I summarize, we're going to make Connor tell a super cheesy dad joke because I've done a whole bunch of presentations on the same stage as him. It's the first time I've ever done one where he hasn't told a cheesy dad joke. So I think we're all due. But my favorite anecdotal story is when I kicked this off 6 years ago, I read this investigative report on Amazon and the fact that one of their AWS server farms in Florida took the same amount of energy as Midtown Manhattan. So just one server farm. And the only reason they were in Florida was because Florida has a pretty lax legislation on using water, and server farms need a ton of water to cool them. So it was an investigative report because Amazon doesn't have to report any of this. And the reality is, shouldn't the stakeholders of Amazon know about this? Because if Floridians ever decide we don't want to give Amazon this much energy and this much water, that's a detriment to just as a shareholder and that stock price. But shouldn't Floridians know that Amazon's taking this much water and this much energy? And then you kind of exasperate that by the fact that that was 6 years ago, that was a CPU server farm. Now you look with AI and the GPU server farm that could take up to 100 times the energy of a traditional CPU server farm. Now you're talking 100 Midtown Manhattans for energy. All we're really saying with this is just the ability for companies to report accurately all their data for all the stakeholders applicable to the company, I think is kind of our vision and mission over here. Now, Connor,
Great.
for the cheesy dad joke.
That's it.
Well, thanks for putting me on the spot, Damien. Not really putting me on the spot because he's right. I do tell the dad jokes quite a bit. Given that we're talking about the energy transition, Damien's probably heard this one, but I don't know if everyone has. What did the wind turbine say to the solar farm? I'm a really big fan. There you go.
Yeah, pretty bad.
It's the response I usually get, just dead, total, utter silence. In any event, no, just thanks very much to you, Sean, and to you, Damien and Art. That was a lot of fun. Always enjoy getting on these presentations and these webinars and that sort of thing. I guess in terms of closing words, maybe an admission against self-interest. I am a lawyer by trade, and certainly we look at these things from a risk perspective, but when we talk to our clients, really what we're trying to do is let them say the things that they want to say, and they need to say. Certainly in the battery space, that has to do with securing capital and that sort of thing. And I mean, there are good stories to be told out there. So certainly keep on telling those stories. But the points that we're raising here, I think, are more from an awareness perspective than anything. We are moving into a new and heavily regulated environment, but I guess if there's any silver lining there, the one thing that I do talk to clients about is, prior to a lot of this regulation, you'd hear organizations saying that there's some sort of competitive advantage to talking about your sustainability efforts. And the ironic part is that was never actually true, because everyone was just saying everything without any sort of backup for that. So if there's any silver lining here, it's that those organizations that actually are putting effort into their sustainability efforts and communicating those out. I think now is the time to actually capitalize on that benefit.
Certainly sounds like it's going to mean a lot more when we hear it now. So that's good. And Art, I'll leave final words for you.
Well, first off, thanks for having me. It was great to participate in this panel. The final word I would leave is it is worthwhile putting some effort into your sustainability program as an entrepreneur. It will translate into value at some point, and it is something that groups like myself value. So I would leave you with, even though it's a huge pain to do, it is something that will be beneficial for you in the long run, particularly if you're looking to sell your business.
Well, great. These have been fantastic insights today, fantastic presentations. So I appreciate you taking the time, Art, Connor, Damien. This was excellent information, and I think we will have the slides available, I believe everybody said, so we're happy to distribute those for you. And thank you to everybody for joining us today. Excellent session, and have a good day.
Thanks, Sean. Everyone.